Hey, what's up everybody? It's your guy Frank, founder of Cobbs Capital, and today I wanted to bring you guys 3 tips about improving your risk management. So, the first tip I want to give you guys, or the first strategy we should talk about, is over leveraging. A lot of people I've seen, whether I'm going on Facebook groups, whether I'm going on the internet and looking at social media platforms like Twitter, Instagram, or whatever, I'm seeing a lot of people talk about, I'm down 900% on this, or not 900%, but 90% on this trade, or I've overinvested into this and I'm down 50%. What should I do? Should I get out now? And I even within my own group, I have members talking about, okay, when should I get out? When should I do here? What should I do there? And the truth is, if you're over leveraged into a position, this should not be a position that you actually are in. So what do I mean by over leveraging? Over leveraging, I mean, is putting either all your portfolio value into one trade in one equity position. You should never do that, because if you do put it all into one position and say, for instance, you lose that all, that's just that much more that you're going to have to recover, or that's just that much more you're not going to be able to trade or invest, whether it be the next 2 weeks, 2 months, whatever, after you've lost that. So over leveraging can also just be too much of whatever you've decided for that trade into one trade. So let's just say you have $1,000 set aside for trading, $1,000 set aside for investing. You wouldn't go up and say, let me put $800 into that trade or into that investment. That's about 80% of that value already going into one trade that it should not be there. So when you guys are over leveraged into a position, you're just too attached to it. Like I said, if you have that $1,000 that you set aside for trading and you put $800 into that trade or investment, and anything goes wrong with it, or it's just very volatile, very risky one, you're just going to be too attached to it. You're going to be monitoring that position all day, all week, and that shouldn't really be the case, because you should always go into a trade with a specific strategy, into a trade with a specific amount of money set aside, or a specific amount of capital set aside that you're willing to lose, or that you can gain off of whatever you've invested into that position. So in general, over leveraging, you don't want to be too much into one position, into one trade. You always want to make sure that when you're going into a trade, you either decide, okay, maybe I'll enter into it lightly, so maybe I'll use half of my money. So again, go back to the $1,000 investment situation or scenario. If you say, okay, I have $1,000 and it's a little risky, or it's looking, markets are looking a little shaky, maybe I'll take $200 and invest, or maybe $300 and invest today, and save that $700, $800 for another time to invest when the markets do get better, or when it's a less risky trade. So in general, guys, over leveraging, you don't want to put all of your account value, or even the majority of what you're looking to trade, into one trade or investment, because you want to see another day, you want to trade another day, basically live to fight another day. So that's what I mean. The second thing I wanted to talk to you guys about in terms of risk management is hedging your positions. What do I mean by hedging your positions? I mean making sure that you're securing, or you're doing the most in terms of risk aversion, and allowing yourself enough time, allowing yourself enough space or enough buffer to be able to recover losses if they are incurred, or to be able to kind of buffer yourself if you do see anything going weird with the markets, with your trading strategy, or just in general, it's a bad trade. So in terms of hedging, one of the things that you can do is buying yourself time. If you're buying yourself time, that's plenty of time you have until the time expires on those options contracts, for instance. And if you are buying yourself time, you actually do not need to, wait for that day, or really have, just sit there watching and say, oh, this needs to hurry up and happen. This needs to hurry up and go on my favor. Because the more time you have, that's the more you're allowing yourself for that position, or that equity, or that trade to go in your favor. And you can just kind of sit back, relax just a little bit, and say, okay, guys, this is what I'm going to do here. I'm down a little bit on this position, but it's not too much. Have a couple weeks left to expiration. I have a month left to expiration. Let's see what happens. So that's one of the things you can do to hedge. Another thing that you can do to hedge actually is buying, the inverse of whatever you're currently invested into. So let's say you bought calls, you're going in on the long side, you're bullish, you're expecting your stock to increase in price. Well, maybe you say, well, let me get puts. Let me, if the markets could go weird like they have all week this week, you could say, okay, let me get some puts. Let me kind of, manage my risk on that side. So in case the stock does fall, then it's like, okay, well, when this does happen, I'm still making money, or I'm still kind of buffering that loss that I'll make from the call contracts that I have now, or my long equity position. So that's also another thing that you can do to hedge. One final thing that you guys can do to hedge is basically buying at the money contracts when you are trading options. I know a lot of people go after those out the money contracts because they're cheap, or they go for those contracts that are, just very, I would say, enticing to you guys. They look very good. They, it's like, okay, the risk reward on those are very nice. But the truth is, those out of the money contracts are those that are a lot cheaper. The truth is, when you are trading those or when you are looking to invest in those, the likelihood of a stock actually getting to that price, or the likelihood of a stock moving, that much in terms of point value or dollar value within that short limited amount of time is very unlikely. So the further out the money you go, that's the further the stock has to move. That's the less money you're likely to make, especially with options, because you're just expiring. Those contracts are burning up premium, and you're losing theta value or time decay every day that a market goes on, or every day that passes, without you actually having gone, or the stock price gone in the direction that you needed to. So that's pretty much hedging, guys. The third and final point I wanted to talk to you guys about is not overtrading in terms of risk management. What I mean by not overtrading is, let's say for instance you set aside a goal for yourself for that day. Let's say you say, I want to make $100 today. I want to make $200, $1,000 a day. Once you hit that limit, don't continue to trade. Don't say, okay, I see some other opportunities in the market. Maybe I'll trade here. Maybe I'll trade there. Because once you start over trading and over exceeding that limit, that's when you might take a loss. You might, actually lose value of what you've traded throughout that day. You might get rid of all the gains altogether that you made throughout that day. And even just in general, you might be putting yourself into positions that have not necessarily done the due diligence on, or that you might not need to be into. So when you are kind of not paying attention to this, or when you are kind of getting into these positions where it's like, so yeah, when you are over trading, or when you are, over exceeding that limit of trades for your day, whether it be, 2 trades throughout the day and I've made my $200, $100, or whether I made my 5 trades today, I made my $1,000. Once you over exceed that, you're kind of going beyond the barrier of what you've already planned out for the day. And the best thing about trading is being able to figure out, okay, go into it. Is this a high probability trade? What's the likelihood that I will make money off of this if it goes into a positive direction or into a negative direction? And then also, what's going to happen if there is any loss? So you also kind of mitigate for that loss and try to understand loss. And when you start over trading, that's what happens to you. Also, too, with over trading what happens with over trading is you might get into a market where you see, okay, it's not many moves to happen today, and you might have not even made a trade today. So you might not have even gotten, your 2 trades for the day, 3 trades for the day. But what does happen when the markets are bad or very unvolatile like they were yesterday, or how they really kind of been all week, then you might force a trade. You might say, okay, I have to make this money. I need to get into it. And the truth is, you can just sit on cash. Cash is a very good position. I like sitting on cash. I don't really trade too much when it's the markets are not too volatile, because I know that the position, or the likelihood of a position going one way or another in the direction I need, is not going to happen. So that's what I do with that. Also, too, I should mention, when you are over trading, when you are over leveraged, and you're taking all these different factors into account, and you're just doing all the wrong things, you go down 10% on a position. Okay, you go down 10%. That's manageable because you can make 11% and recover that. But then if you go down, let's say you go down 50%. Well, if you go down 50% on a trade, then that's 100% value you have to make back just to break even. And then let's say you go down 80% on a position that you've been trading, you over traded, you were over leveraged, whatever, that's 400% that you have to make back in order to break even. And then, even if I do 90%, right? You go down 90% on a position because you're over leveraged, you are over trading, you didn't manage or mitigate your risk properly. What happens? You need to gain 900% value back just to break even off of 90% down trade. So guys, all in all, just make sure you're managing your risk properly. Just make sure you guys are understanding how risk management goes. Of course, these 3 values or these 3 factors are not the only way that you can manage risk, but they are some of the most important ones that I use, that I would suggest to you guys to look forward into using, because they are the best things that you can help out, or that you can use to help out your trading journey. And also, too, when you're coming into the big leagues, when you're making more money in terms of trading, where you're really trying to build account value, it's all about how you protect that money. It's all about how you can manage your risk, and it's all about how you're able to continue trading on the next day, the next week, and the next month. So, all right, guys, I'll talk to you later. Hope you enjoyed.